And welcome back to NinjaTrader Live. I'm your host, Tom Schneider, CMT with NinjaTrader. And on Traders Workshop, we like to bring in our NinjaTrader ecosystem partners. This week, we have returning to the live stream, Brannigan Barrett, founder, CEO, Tradelo. I'm going to try and say that right. Brannigan, how you doing?
Yeah, good. Thanks to you, Tom. Thank you for having me on the show again.
Oh, our pleasure as always. I thought we had a great conversation last week, so topical, and a lot has changed in the 2 weeks that we've seen each other, right?
Well, yeah, I mean, we're going to talk a lot about Bitcoin and gold today. One is dropped 9% and the other one's up, 25, 30 odd percent, depending on where you measure it from. So a lot to talk about since the last 2 weeks.
Yeah, you're right. Now, it's funny you say that because Jim and I were talking last week about gold and Bitcoin, and I said that might be a really good pairs trade. And when we talk about pairs trades, maybe you're not familiar if you're new to futures trading, but it's really trying to pick two markets that are correlated but oppositely correlated to take advantage of that spread, essentially. And gold and Bitcoin after the election seemed to me it's like, yeah, this might be that spread trade.
Yeah, I mean, I think it depends how you look at it. I think at the end of the day, both are driven by dollar fundamentals.
Mhm.
But Bitcoin is very much driven by the risk on theme, whereas gold is very much driven by real rates theme. And that's kind of where I think we have to go today. We have to understand the playbook of Bitcoin and the playbook of gold, because gold is obviously following the playbook. Bitcoin, not so much. And I think that's where there's a golden opportunity, pardon the pun, in Bitcoin. Yeah, but we can talk a little bit about that. And maybe, I've prepared two playbooks for the viewers that I think it's, you often hear about hedge fund managers, institutional fund managers talking about they have a playbook or they're leaning on the 2008 playbook. And I kind of want to just share an idea of what their playbook looks like. Obviously, this is a topic for hours of discussion. But yeah, I think it'll be a good opportunity for the users to understand what are the key macro drivers of both Bitcoin and gold. And why is it that I actually think Bitcoin is pretty much very close to a topping out process now? And it's following a very similar pattern to what we saw in 21. So I'll bring up that chart in a minute, but I'll let you direct the conversation.
Yeah, no, yeah, I think, when we had talked last, we talked about and we did this offline. We didn't talk about it on screen, which would hit the milestone first. And as a late comer to the game, Bitcoin, we kind of entered that in the discussion as 100,000 as a target. E-mini, of course, the 6,000 target, gold is the 3,000 target. And I was a little surprised, not too surprised, but a little surprised E-mini hit it first. I didn't think that the election results would propel the markets as much as they did in the stock market. So that was kind of me misreading that. But interesting that for these reactions were a little bit excessive, I thought, right away. And maybe the market was just waiting for the relief of the election to be over. But um, what
Yeah, I mean,
we can start with gold. What are the gold beats that you're looking at in the playbook you
gotcha.
speak of?
Yeah, I think the way to look at it, I mean, the user should definitely take a snapshot of this and kind of see this as, what are the key drivers of the price of gold up and down. Now, for those that are new to gold, gold is very much a boring product. Okay, if you've not traded product gold for many, many years, it's a market that very seldom moves. But when there are fundamental drivers or very specific fundamental drivers in the market, gold does move. And I've listed these in orders of the most sensitive. What is the macroeconomic theme that gold is most sensitive relative to the least sensitive? Okay, you go back to the 70s, and you often hear this now. People talk about how gold is a hedge against inflation. Yeah, sure. In the 70s it was. We had double-digit inflation. You fast forward to post-COVID, we had nearly double-digit inflation, and gold didn't exactly double in price like it did in 74 and 78. So it's not that gold isn't an inflation hedge. It's just that inflation is not the primary driver of the price of gold. Okay.
Mhm.
To understand the primary driver, I mean, I'm actually going to go through the top two, which is real interest rates and inflation expectations, but I'm going to do it with a visual so the users understand it. Now, don't worry too much if this doesn't make absolute sense. Okay. It's something you need to go and understand, look at the charts on. But what you've got here, in essence, in the purple is real rates. Okay, think of that as the level of interest rates 12 months from now versus, subtracting from that where the market thinks inflation will be 12 months from now. Okay, and what you get from that is a real rate. It's effectively the rate you will earn over and above inflation over the course of the next 12 months. Okay, now what you can see in the purple is that it's currently around 1.36%. Okay, positive real yields. In the orange, then we've got the price of gold. Now, the primary driver of gold has always been the combination of real rates and inflation expectations. How to think about this? If the Federal Reserve sets policy at too loose a stance, okay, so real rates are not high enough, effectively, the market will then push inflation expectations up. As a result, market participants will want to own gold, okay, because it's a hedge against higher inflation expectations. And obviously, the opposite is true. If the Fed sets interest rate or real rates too high, so they push rates far too high that it actually brings inflation down below their 2% target, we then start to see negative real rates, and as a result, gold sells off as a result. Sorry. In a high real rate environment, gold sells off, and in a low real rate environment, gold rallies, okay? So that's the construct of what drives gold, but it's not just the absolute level of real rates, is that absolute level capable of controlling inflation expectations? And that's the key to gold, because if you just looked at gold versus inflation expectations, you would see that over the course of the years, we've had really high inflation expectations, yet gold hasn't rallied, okay? So it's very, very important that it's all about the medium term. Where is that inflation going to be in the medium term? And ultimately, what is the Fed doing to the level of real rates to control that medium term of inflation expectations? So that's how you need to look at gold. Now, I think to study gold particularly, you need to go and look, and I've dated this back to sort of 2020, because that's when we saw COVID. Okay, think COVID, the Fed obviously reacted. They cut zero bound. They did another 5 trillion of quantitative easing. So they drove these real rates all the way to negative levels. Okay, I'm just going to illustrate that on the chart. But you can see we had real rates very, very low. Now, if you just looked at that absolute level, you would have said, well, why didn't gold significant rally in that time? Okay, moreover, when we did start to see that double-digit inflation, why didn't gold significantly rally? Why were we not capable of breaking out to record highs? It was because the Fed began very quickly raising those real rates to stem any potential inflation expectations becoming embedded. Okay, so it's very, very important to understand. It's not the absolute level of inflation expectations that matter, rather, what is the level of interest rates right now, and what are the implications for inflation expectations because of that level? Now, let's talk about current day, because that's what everyone's interested in. Right now, what has the Fed said to us? Okay, to understand what the Fed's telling us, we need to look at the start of this year. January this year, the Fed told us that inflation expectations are well anchored. And we remember Powell pivoted in December. Okay, so what happened was we started to see those real rates drop off, and gold said, well, okay, hang on a sec, you're not yet at 2%, so gold rallied. Moreover, Jan, Feb, March came out. We saw higher than expected inflation. What did Powell say? He said they speed bumps. We'll look past them. Moreover, in March of this year, he also said we no longer expect to get inflation back to 2% this year. Rather, we think and we accept that we'll only get there in 2026. What did gold do? It said, no, thank you. We're not accepting that. Okay, we don't accept that you're just going to accept a higher level of inflation, because ultimately, the Fed's job is to maintain a 2% target over the long-term horizon. Okay. Now, of course, we then had the very, very big bid up in real rates when interest rates. When the real rates started to rise, gold plateaued out. The market said, okay, fine. If real rates are going to rise, we don't really want to be owning gold. But then later on in the year, August, we had Powell flip-flop again. He then signaled to the market that rate cuts were incoming in August at Jackson Hole. As a result, the market said, well, you still don't have that inflation expectations back at target, and gold took off again as those inflation expectations dropped. In other words, the market is signaling to us right now that not necessarily it's a policy error. The market's just saying that rates are not restricted enough. Real rates are not restrictive enough. They're not high enough ultimately to justify or to bring down the level of inflation moving forward. And that's why gold maintains this bit. Now, going out to next year, we have to say to ourselves, well, is this dynamic going to change, or what changes this dynamic? Well, it's simple. If the Fed tells us they're going to pause in December, yeah, you are going to see these real rates effectively respond, and you will see gold respond. And that's exactly what we've seen now post-election. We saw the market price out those rate cuts. Real rates ultimately have been coming off over the course of the last couple of months. And as a result, gold took a little bit of a fright. Why? Because gold's saying, well, look, if the Fed does pause, they don't cut as much as we think. Well, ultimately, we don't really want to own gold in that situation because inflation should ultimately start to taper off again because of those higher rates. Okay. Now, I know that sounds like a mouthful, and it is a mouthful. And that's why you've got to go and get this chart up. You've got to try and map out real rates and inflation expectations as well as gold, because that will start to give you an idea of how gold moves with this idea of rates, real rates and inflation expectations.
So that is great information about real rates. Can we glean anything from the bond market, kind of rejecting these rate cuts as a measure of lower interest rates, as kind of another way to say, you know what, the market doesn't believe that we're restrictive enough, and therefore maybe gold will get a little bit of a bid?
Yeah, I think that's exactly what the markets are saying. Again, I wouldn't say that the markets are saying we're not restrictive enough. I think the long bonds are responding to this idea that, the economy is a lot stronger than what we initially thought. And if the Fed does want to continue cutting as much as they think, the result is we've got to have higher long end yields because inflation is not going to come back down to target. I was listening to an interesting podcast. I mean, I don't know if your viewers listen to the Odd Lots podcast, but Fed's Clarida, who was the vice president of the Fed for many years, he was discussing ultimately the Fed's sort of outcomes, what their options are next year. And I think one of the key things he said is that if you take a look at the 12-month PCE, in other words, the Fed's preferred gauge, it's effectively stagnated. It's not done anything over the last 12 months. Okay, it's pretty much flatlined. And his whole sort of point was that what that showcases is that inflation's a lot more sticky than the Fed wants it to be. Okay, now,
Yeah.
if inflation's sticky, that's why everyone wants to own gold. If inflation is not coming back down to target, the Fed cannot continue cutting. As much as they'd like to, they cannot keep cutting with a straight face if inflation starts to rise. And I think that's the early signal market has sent now. It said, look, it's fine. We recognize you wanted to get off very restrictive levels. You wanted to get ahead as an insurance cut. But I suspect what's going to happen, we'll get one more cut from the Fed in December. I think they'll continue on this process of cutting. They'll then pause at the January meeting. And should inflation pretty much not move down beyond that January meeting, I suspect we could very much be at the end of the rate cut cycle. But again, I say this is just an opinion. Okay, it doesn't mean I'm stuck in that view. It means that, I will go to January with that sort of mindset. And should they pause, then yes, I think gold is in trouble should they pause as early as January. But right now, nothing suggests they're going to pause. If they cut in December, again, they are just sending the signal to the market that they're going to keep this process of cutting. Inflation is definitely not going to come down in that scenario, and no one's going to give up on those gold longs until that Fed flips towards pauses and perhaps ends the cycle.
Yeah, it's interesting. We watched the Fed Watch tool. We've seen the Fed Watch tool lose certainty, lose probability in a cut, and it's kind of swinging towards a no cut even in December. Now, I don't buy that. I think you're right. I think there's one more in the can for this year, and we have one more data set, right, from pretty much each of the different measures, right? PCE, CPI, will come in once again. So they're always going to fall back on data dependency to make their decisions. So, what's interesting with that is with the cuts, though, it also makes gold a little bit more attractive because it isn't an interest-bearing asset, right? So gold doesn't spin off any payments as competing investments like interest-bearing investments. Treasuries is the first thing I think of. As if those yields start to come down, then you might say, okay, that could buoy the gold market too, right?
Yeah, I mean, of course. Again, I think you've always got the idea you're thinking of and pointing out is there is an absolute level of yields, real yields, where investors say, hang on a sec, why would I give up 3% risk-free owning a treasury bond and instead of holding gold?
Right.
But that absolute level is clearly, we've not been at that level this year, because if you look at, and I've got a fascinating chart. In fact, I'm just going to fast forward to this because I think it's well
Sure.
worth
Yeah.
discussing. Okay, if you look at this chart, effectively we're rebasing everything to gold. Yeah. Okay. So I wanted to showcase to you how Bitcoin has performed, because I think there's a bit of a misleading idea that gold is a store of value. That's absolute rubbish. One day it'll be a store of value. It's not a store of value right now. And we'll look at that using an objective chart. But the key chart I want to take away in the purple, what we've got is US 10-year bonds. Okay. Now, if we rebase that to the gold, so if you think of zero line as gold, bonds, owning Treasury 10-year bonds, have massively underperformed gold for the last 4 years. Okay.
Right.
Now, if you think that was in a rate hike cycle, how can bonds be massively underperforming gold in a rate hike cycle? That makes absolutely no sense. Now, the only reason or the only way that can be true is that we've not reached an absolute level where it makes sense to own bonds over gold. And I think that just drives home the point. You are right. There is a point, an absolute level. If 10-year yields were at 10%, fine. No one wants to own gold in that environment, and you'll massively see the long bond outperform gold. But right now, long bonds is a very much an underperforming strategy relative to gold over the last 4 years. So hopefully that drives home that point that, yeah, you're right. There is a level of yields where gold struggles, but we've not seen it yet, not in this hiking cycle.
Right. And for those who are new to this kind of charting, I think I love this. I love the comparison charts. There are different ways you can look at the same things. This is actually saying which market has outperformed and which market has underperformed. So it doesn't tell you anything about how gold has done over the last 5 years, 6 years, whatever this time period is. All it's saying is the market, the S&P, has outperformed gold by X%, and the bonds have underperformed. I'm assuming that's X%. It might not be percent. It
Yeah.
might just be
Yeah.
a
Yeah, no,
index.
it's percentage. No,
It
it's
is
percentage,
percentage.
definitely. Yeah. Yeah.
So, this is where the data visualization, I just love data visualization because it tells a story in each chart. That's a
Yeah,
great
I
one.
mean, we did the same thing with Bitcoin. I mean, maybe let's just talk
Yeah,
about Bitcoin,
sure.
Tom, because it's very topical. There's the playbook for Bitcoin. I'm not going to go through this in great detail. You can take a snapshot of it. You can reach out to me on Twitter and we can discuss it. But Bitcoin has got its own set of fundamental drivers. Store of value, no, it's not one currently. Will it be one day? Possibly. I think there is a lot of potential for Bitcoin to be a store of value. But at this point in time, I mean, we're talking about a 1.7 trillion market. It's not exactly, anywhere near a store of value, and it does not currently showcase the characteristics of a store of value. One day, perhaps. We're not there yet. Now, what I wanted to showcase is what is the key driver of Bitcoin, because I think there's a little bit of a misunderstanding that Bitcoin is this thing you hodl forever. But in reality, Bitcoin is nothing other than a tech stock. That's kind of how you have to think about it. You can see those correlations. I've got this up. It's the Nasdaq in yellow. It's Bitcoin in orange, and you can see that they are near directly correlated. When we had that significant rally off the March 2020 lows, the COVID lows, that's when Bitcoin stages rally. When we topped in Q4, when the equity markets topped in Q4, that was the top for Bitcoin. When we, staged the bottoming process last year in October in 2023, that was the bottom for Bitcoin. Okay, it is effectively just a risk asset, and that's the best way to understand and interpret. Sure, there are other plays, things like dollar devaluation. Okay, if we had significant dollar devaluation, fine. I can understand why people want to own Bitcoin as a distraction against fiat. It is just another form of fiat. But right now, the best relationship for Bitcoin is effectively the Nasdaq. Now, one thing I want to point out, and this is something that be aware of. Okay, particularly if you're someone that does get influenced heavily by social media. Bitcoin pre-election was trading 62,000. Okay, we gapped up on one of the weekends when one of the polls showcased Trump was doing very, very well, and effectively to date we're trading, call it 90,000. Okay, so we've effectively had a 50% rally since Trump started being priced in as being the outright winner. Now, what I want to point out is if you go look at, and I just want to highlight this specifically on the chart, if you go and actually look at 2021 and you studied the NASDAQ topping process, that's this little point over here, okay? What you'll notice is we kind of had this rally and then we sort of went sideways for a significant period of time. We then popped up, you can't quite see it over there, but we popped up in November to make a new record high. It was very, very brief. We popped up, locked everyone in at record highs, and that was the top for the equity markets.
Yeah.
Okay. It was the top for Bitcoin as well. Now, if you look at what we've done, in the Nasdaq, okay, we've just popped that record highs, sat up there for a day or two, being happy about the election result. We're now back in below that. Keep a very close eye on this, because ultimately, NASDAQ led that move to the downside. Bitcoin got dragged with it. Everyone has bought into this breakout. Okay, like I said, we are up 50%, 62,000. We're up 50% since that election result. The outcome of a favorable, sort of Republican win is very much in the price of Bitcoin. As much as there are people telling you it's going to $1 million, don't be fooled ultimately. Okay, Bitcoin is driven by risk markets. And I suspect now we are very, very top heavy. Okay, a lot of people have bought into this breakout. They're all long. They're all very nicely on side. Now, unfortunately, Bitcoin's not a natural sell market. It's not something you ever want to naturally be short of. It is a market you can short when technically they're structured to be short. But it's not something you just sit and be like, nah, I want to short it because it's going to go down in the next 3 to 6 months. Okay. So right now, I suspect at some point in the next couple of days and weeks, we are going to get a pretty aggressive, nasty sell-off. You get back below that 72,000, that 62,000 is going to come into view very quickly. Okay. But like I said, it's not something you want to naturally be short of. Okay, you're going to need to let that NASDAQ continue its rotation lower if it continues lower. Okay, if it doesn't, like I said, Bitcoin is nothing more than a risk asset. So just pointing out that similarity between the topping out process in November 21, very, very eerily similar. Okay.
Yeah.
Yeah, that's a cool chart.
That is, and we've noticed a little bit about that correlation in terms of the movements, in terms of the inflection points, not to this degree. We haven't pulled up the charts by any means, but Bitcoin is kind of that tech bro, what is it? Tech bros, they call them. It's kind of among that, new technology was introduced, the blockchain. It kind of fits in with that Silicon Valley attitude, and NASDAQ, of course, reflects that. I wonder how much of this, you're right, is that exuberance from the results of the election. By the way, a lot of crypto, I don't know, investors did contribute to campaigns quite heavily, more so than they've done in the past. And I think this was, maybe the result. The new administration will be a little more favorable. All of these stories, you're right, but it's easy to lose this kind of technical charting in all the news you're going to hear.
Of course. And I mean, one thing not to forget, and I think this is a good sort of point to highlight. At the start of this year, if you go look at the market cap of Bitcoin, the start of this year, we were call it 800 billion. Start of this year. To date, we're 1.7 trillion. Now that 1 trillion's come from somewhere.
Right.
Okay, remember, money moves around. So sure, over the course of this year, no one wants to hold bonds. A lot of people are sitting in cash right now because it's yielding a lot. So that 1 trillion's come off the sidelines from somewhere. Okay, now it's not come out of the equity market because equity markets are record highs.
Sure.
So the market cap is put on $1 trillion and nothing fundamentally has changed for Bitcoin this year. Okay, sure, fine. There might be a president coming in who's more favorable towards the industry, but it's not like he's going to sit there and buy the thing up. Okay, so just don't, and I think you nailed it on there, don't lose sight of the objective facts. Can we go to 1 million over the next 100 years? Of course we can. Anything can happen. We can go to zero as well. The point is trade what you see in front of you. And right now, we've added $1 trillion. We're up 50% since the election. NASDAQ's turning over. And might I add, one of the key drivers, this is important to stress, one of the key drivers of Bitcoin is the dollar. Okay, dollar is up a significant amount, and that's not about to change. The consensus trade is long dollar for next year. In that environment, Bitcoin does not outperform. So I think that's just a good way to look at it. Okay, good tradable market, by the way. Absolutely encourage traders to trade it, but just be holistic, be objective. Don't be sucked into the hype cycle.
Well, and one of the interesting things I find about Bitcoin is there's a limited amount of Bitcoin that will ever be mined. It'll take more than a decade to get there, probably 2041 or 42. We've never really had that, I don't think. I can't recall any futures market where we had the underlying being limited. You might call gold. Yeah, of course, there's only so much gold in the earth. There's only so much oil, but we're not going to reach that in our lifetime. That just makes me wonder, is that a good thing or a bad thing for the Bitcoin market? If the miners stop mining and we've got this asset, there can be no, there's a limited supply. What does that do to the price? I don't know. I can't get my head around it.
Well, look, I think that's got to do with the mining fees. At the end of the day, the Bitcoin miners now are incentivized to ultimately keep mining it.
Right.
But at some point, the fees will justify them continuing safeguarding the actual blockchain. So again, when it comes to the actual technical details of it, yeah, I'm as clueless as the next guy. So I'm not going to be drawn into that. At the end of the day, my job is to trade the price, to understand the key drivers of it, and that's what ultimately matters for me. So yeah. by no means an expert when it comes to the technical details of the underlying.
I was at a CMT event, and I forget who it was. Frank, I think maybe Frank. I'd have to look back, but he said if I can look at it on a chart, he could trade it, right? That was his attitude, right? He doesn't have to know the ins and outs of everything, right?
Yeah.
If he has a chart, he can trade it. So that
And I
was
think
his.
that's where the day traders love it, Tom. Because the
Yeah,
reason, the day traders, the prop traders love this market is because if I show you on the chart, when we broke 73,000, we didn't stop to 96,000. It repriced that in a week. Okay, that's
right.
sort of a 15 to 20% rally in such a short space of time. That's what we live for. And again,
Sure.
this doesn't happen often. I think Bitcoin staged 3 of these types of rallies over the course of the last 10 years, right? So it's not like we're trading this actively. In fact, I don't know many successful day traders that do trade this actively because it's very expensive to trade. Okay, crossing the spread and the fees to execute are not cheap, but we do take those opportunities because when it breaks, okay, no, like I said, there's no natural sellers. No one wants to provide liquidity to this market, so it goes a lot further than what you expect. That's where the
Right.
edge is in trading this market now. That may change. Okay, like I said, if this does become a store of value, guess what? It becomes a bit of a snore, like a gold
Like
market.
gold.
Okay, if you
Yeah.
add on a couple of more trillions of dollars to it, eventually it's going to become very, very boring. It'll be volatile only when there's new fundamental drivers. So enjoy it while it lasts. I think that's the key takeaway.
Brannigan, it's been fun talking to you as always. Where can people find you?
Yeah, I mean, I'll just put that up for users to have a look. Yeah, follow me on at @traderbrand_traderbrand, sorry, on Twitter. I'm quite active there. Always happy to take on comments, and I do post a lot of the ideas, the plays, and all that. We do have a daily market rundown we do for the traders just to kind of keep them up to date on what's moving. And then of course at Tradelo Trading, if you want to watch our content, our education, it's all there for free. Go and learn about the futures market. And like I said, the more you engage with us, we're always producing content for the traders. So there you have it.
Thanks again, Brannigan, and we'll do this again.
The following presentation is for educational purposes only. All the symbols, trading ideas, and market commentary are for educational and demonstrational purposes only and are not recommendations or trading advice. Live sample trading occurs in a simulated environment. Past performance may not be indicative of future results. All the information and content presented is provided by NinjaTrader LLC, and the opinions expressed by all third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.